November 8th, 2023. Today we got a measure move up. You can see that this was essentially attempting to form a wedge. It's one push up, pull back, second push up, which subdivided into two legs, and then a third push up and a third attempt down. And then we got a big bull surprise on 47, and bulls are going to try to get a measure move up, and we basically did. And it's pretty good buy above 47. You know, you're risking 6 points and you're trying to make 14, maybe you have, I don't know, 45, 50% chance of doing so. So I think it's a pretty solid buy above 47. Um, Additionally, up here, there's the magnets of the day, like the open of the day. So, it's more reasons to think that we're going to get up to this area. Bar one, big bull bar, but not, or very strong close, but not very good context. You're breaking above yesterday's high, and you're trying to get a breakout of this trading range, but you need to be thinking that if it's a trading range, what usually happens in trading ranges when you try to get a breakout? Breakouts generally fail at trading ranges. And so when you get bar one, it looks good, but the reality is we're probably going to at least pull back and let the limit order bears who sold above the breakout, they're probably going to make money. You can see they do on bar two. And if you sold the high of bar one, so let's say you sold above bar one, look where it went to, exactly the low of one. And those bears, it's a 5.5 point bar, so they sell one tick above, and they're able to make exactly a 5 point scalp on two. So if you had bought above one, and you're still, let's say you had a stop below one, and you don't get stopped out, how do you feel about the fact that the bears made a 5 point scalp? Well, when you're hoping there's going to be a bull trend, probably not very good. So, important to keep that in mind that limit order bears are already making money, so it's not as good for the bulls as it could be. Bar three gets back to the one close. You can see anyone who bought one is obviously disappointed in two, and a lot of those traders are getting out around the close of one during three, and that's causing a lot of the selling. Four, another bull bar, but what do you think is going to happen when we trade above two? If bears sold above one and made money, they're probably going to sell the next breakout. A better way to look at it, I think, would be, the bears who sold this breakout made money. So bears are probably going to sell this breakout as well, and they're also probably going to make money. And that's kind of confirmed when you get really bad follow through on bar four. Bar five, also a bad follow through for the bulls. Basically just a doji bar. There should be some buyers below it, but it did something really important after we got bar six. You can see we got a big bear bar on bar six. It's not closing near its low, but for me, for most traders, I think it's enough to make you think that we might head back into this trading range. And so what happens is on seven, look at the tail on seven. It went one tick past the low of five. So the traders who bought, the low of five are disappointed in six. They wanted us to quickly trade below and then get another leg up and hopefully a third push up. And it doesn't seem like we're going to get that with how six closed. And so a lot of those traders, when we get back up to that price, they're selling out of their longs immediately now. So it gets back to this low and they start selling. And that selling pressure is causing the big bear bar on seven. Seven's an interesting bar. I think it makes the market always in short, or most likely does, but there are problems with it. One of them is it's a vacuum test of yesterday's close. And if you look at, six is not what you wanted. So six, it could essentially be a two-legged correction, one, pull back two, and a steep second leg. And the market's probably always in short, but the problem is if you get a bull bar after seven, then it's really unclear. And strong always in usually means that if you get one bar in the other direction, it's not going to flip the always in direction. So traders selling below seven are probably going to be concerned that we might get a reversal up. And also, it's really subtle, but the tail on seven is bigger than you want it to be. It's not a very big tail at all, but you just want it to close pretty much on its low because it's the very beginning of the trend, and you want the best bar possible at the very beginning of the trend. And it's not as good as it could be. And so you can't be as surprised when we get bar eight, and that makes seven a potential bear trap. So we get a big bull bar on bar eight. And I thought nine did something interesting as well. If you sold below seven and you sold more above eight, you were let out during nine. So if you're a bull and you bought above eight, hoping that this was going to be a bear trap, you're disappointed that nine let the bears out who sold and scaled in higher. So that's disappointing, right? You don't want those bears to be able to get out. And then when 10 trades down and touches the seven close, the rest of those bears were let out at break even as well. You can see they took that chance to get out at break even. And that's why when it got down here, they started buying back shorts, and that's causing the buying here. And so what are those bulls thinking? They're thinking, well, if you're buying below, or if you're excuse me, if you're buying above 8, your premise is that it's a bear trap, right? And that we're going to rally to the top of the sell climax and potentially further. And now the bears who sold and sold more higher are let out at break even. The bears who sold to close and just waited are now also out at break even. So is your premise of a bear trap all that valid? Not really. And that's why we get 11, because the bulls realize that their premise is not valid. So they, when this bar closes and it's not just the best bull bar in the world closing on its high, those traders are going to get out quickly. And that's what's happening on 11. And that's causing the bear bar. However, since it's bulls selling at longs, we don't end up getting much follow through for the bears here. Bears were hoping we were going to get a strong close below this double bottom and maybe get a strong breakout down, but we don't get it. We get a big tail on 12, on 11. Doji bar on 12, just bad follow through in general for the bears. It's not good to buy above, but it's not really great to sell below either. This is starting to look like a bear channel, which is what it ended up being. And generally when you get, on the open, a bear channel like this, this is a little tighter than you want it to be. If you're a bull, there's just no reason to buy in here. I thought that, actually, I'll get to that in a minute. But bear channel. So 13 outside bar, didn't quite, basically another doji, not really anything going on here. No reason to buy or sell. Best for most traders to just wait. 14 trades down, and it seems to just be testing this close from yesterday and the low. Or this close is what I meant to say. This close and this low, because it was a big bear bar, and the traders who sold this close did a reasonable thing and should be let out at break even. You can see they were let out at break even, and they were buying back their shorts, and that's causing 15. What about buying above 15? Well, this looks like the start of the bear channel, so not that great. But I thought what was more important was the fact that the tight trading range there was a clear tight trading range on 12, 13, and 14. And 15, if you're going to buy above it, you're hoping that you're going to get a big bull follow through bar. And one of the reasons you need a big bull follow through bar is because you're buying the top of a tight trading range from 12, 13, and 14. But if you look at 15, 15 did not close above the top of the tight trading range. It didn't break out of anything. If 15 had broken out above 13, it's a better buy. I still don't think I would take it. I think it's better to wait for follow through, because what's the rush to get in, right? If you're buying above 15, let's pretend that 15 broke out of the top of the tight trading range, which I think it not breaking out of the top of the tight trading range makes it a really good reason to not take that trade. Same thing with 27. This is a tight trading range. It doesn't break out of the top of the tight trading range, so you don't need to be buying there. But if 15 had broken out of the top of the tight trading range, and you're wanting to buy above 15, your premise is most likely that we're going to get a swing up for, a couple of hours at least. And if we're going to get a swing up for a couple of hours, why get in on the first bar when it's pretty risky versus just waiting for a follow through bar when your probability goes up a lot? And the traders who do buy above 15, what do they do when they see 16? Well, if I bought above 15 and I saw 16, I'd be extremely disappointed in 16. And those traders are disappointed. And so they're flattening at the market, and that's what's causing the selling on 17. You can see we basically they didn't even try to get out around their close of 15 because they were too concerned that we were still stuck in the middle of this tight trading range. They're going to be really fast moves up and down. So then one of the things that's causing those fast moves is traders being concerned that this is still a tight trading range and we could easily go to the bottom. And so they all start panicking out, and all the traders panicking out is causing this selling. 18, we got a tail back up, traded above or below 16. These bars like 15, maybe 8, but I kind of thought 8 was an okay buy. It looked better on SPY than it did on the mini. It was a bigger, better close, and it was micro gap up instead of micro gap down. And it wasn't right on the moving average, just below the moving average. Also, if you have thinkorswim, if you put in then a negative sign and then the /ES, it gives up the exact inverse of the chart, and you can watch it real time. It moves with the market real time. So if you're ever wondering if you're being objective and you want to look at the other side, if you do /ES on thinkorswim, it'll show you the other side. Just something to note. But anyways, so those traders were disappointed. They sold out of their longs, and 18 trades up and lets the limit bulls make money. The overall point I was trying to make is these bars make better buy belows. Not maybe 8, 15, 21. These bars are all better to buy below than they are to buy above. 22, because, it's still in tight trading ranges. And just as the breakout to the upside is probably going to fail, the breakout to the downside of the bear channel is also probably going to fail. 19 inside bar, but it's not really all that strong. It's got a tail on the top. And something really important to note is you always got to be thinking about, all types of traders. So stop order bears, stop order bulls, limit order bears, limit order bulls. Limit order bulls are clearly able to make money in this, right? You buy below 8, you scale in lower, you scalp out. You buy below 15, you scale in lower. You buy below this, you scale in lower. You can buy below pretty much anything in here and scale in and make money. Bears, they can sell above pretty much anything and make money. Stop order bears, it's harder to do, but stop order bears have been making scalps. And then show me a spot where I'm talking about bar up to bar 19. Show me a spot where stop order bulls have made money, a reasonable amount of money. If they bought above 8, they were able to make literally 1 point. Does that sound like it's a logical thing to do, to buy above 8 to make 1 point? Not really. If you bought above 1, your true risk becomes huge on 2, and you're able to make, again, not even 2 points because it didn't trade 2.5 points up. So you're really only able to make 1 point. So if all bulls on stop orders have made today is 2 1-point scalps, that neither of which was very good, you shouldn't be taking any stop order trades for the bulls. Do you think that, it's not smart to try and be the first bull to make money? So inside bar 19, probably buyers below, like there were on 20. Any bulls who were front running 19 were hoping it was going to close on its high and set up maybe a potential swing. But again, still tight bear channel is the problem. And that's one of the reasons we got buyers. That's one of the reasons we got sellers on 20 is because they were disappointed in the close of 19 and they just exit their longs, and that causes 20. 21's a bull bar, not quite able to close on its high. It's still within the bear channel, and 21 does something important. It breaks the bear channel line. So we had basically the spike down 6 and 7. Now we have a bear channel, and then you break the channel line, and so we might start to form some kind of trading range here. Additionally, the traders who bought above 21 were able to make a 2-point scalp on 22. So limit order bulls or stop order bulls starting to actually make a little bit of money. But you can see the traders who bought above 21 were disappointed that 22 wasn't able to close on its high. So they all sold out of their longs, and that causes a lot of the selling on 23. But again, some bulls bought below 21, some bulls will buy below the breakout, and they're expecting to make money. And you can see 24, 25, they are able to make money. It's the reason there's a big tail on 25 is because, well, I'll go over 24 first, but for 24 is an inside bar with a big tail on the top. It's disappointing for bulls. They were hoping that we got a trend line break and a lower low, major trend reversal, and a swing up, but we're still kind of within the bear channel. So it's not as good as it could be. And if you bought below 22, think about how you're feeling when you see 23. Really not all that good. So although it's nice that 24 and 25 trade up, sorry, that's not what I should have said. What I should have said is if you bought below 22, you're disappointed in 23. So you're scaling in and you're still probably going to make money, but those traders are going to be pretty eager to get out. And that's what's happening here on 25 and 26 is traders who bought were willing to scale in lower, but they're scalping out. And usually it has to go one tick past the 22 low for those traders to make money. And that's another problem with 27 is that the bulls who bought more lower haven't made money yet. Some of them have, but definitely not all of them because it needs to trade one tick above the 22 low for them to all make money. So if you're buying above 27, you're buying the top of a trading range where a lot of other bulls might be selling. It's true that it could be a trend line break, lower low, and then you get essentially a higher low major trend reversal. Because usually when you get a lower low major trend reversal, you need a higher low right after. And this could be, one pullback higher low, but it could also be one pullback two, selling right where or buying where other bulls are probably going to end up selling. So it's really not as good as it could be. And that's why you get a disappointing bar on 28. And it's another one of those things where you're still in the bear channel. And if you're buying above 27, what's your premise? Your premise is that we're probably going to get a strong rally. We might end up all the way back up here. If we're going to end up all the way up here, you have a lot of bars to make profit. And bulls have continuously, they've been disappointed every single stop order trade today. 1, 8, 15, 21, now 27. So they've been disappointed 4 times today. they're probably going to be disappointed again, which they were on 28. Traders, they see 28. Some traders exit below 28, and that's causing 29. Bulls are buying below 24, and they're going to be willing to buy again below the breakout point, expecting that they're going to be able to make money. But 30 does a really important thing that we haven't really gotten yet today, and that's a strong close near its low below the breakout point. So it's a strong close below 24 or 23, and the Bulls have tried 3 or 4 times today. So the Bears are now going to try and get a downside breakout. So I think 30 also makes the market clearly always in short. The always in was really fuzzy early in the day. And, bars like 8, 15, 27, they all need one more bar to clearly flip the always in, and they're just not getting it. But I think that 30 makes the market pretty clearly always in short. And that's why it starts to get follow through on 31, 32. But the bars are big and climactic, meaning that it's probably going to be an exhaustion gap rather than a measuring gap. So as strong as this looks, these bars are getting bigger and bigger, and they're getting huge, and there's a big tail on the bottom of this one. And so if you sold below 30, you have basically no true risk, and you have, at this point, I don't know, you could have made 10 points. Some bulls sold below 30, made a quick 10 points and scalped out. That makes sense when your true risk is almost zero. And a lot of other traders saw the close at 32. Too much risk of a bounce to stay short, and those traders will just exit at the market thinking they have a good profit, and that's causing the buying pressure on 33. The exhaustion gap essentially is. I want to try and talk a little bit more about this because this is. I'm still, I'm obviously still learning, but when you get these breakouts below flags, you kind of have to think about whether it's going to be a measuring gap or an exhaustion gap, and that's obviously has a lot to do with the context. But you're 20 bars into this bear trend that started at 6. So you're maybe like 25 bars in, and the bars are growing in size. And so most likely you're going to get back up to the top of the sell climax, which is here. And a lot of traders will do is they'll wait for a bull bar closing near its high, and then they'll buy above the bull bar, expecting at least a couple legs up and potentially to get to the top of the sell climax. 33 inside bar and 34 inside bar. So it's an II pattern to 34. I think a lot of bears are going to be looking to exit shorts. You could maybe go long, hoping that we get to the top of the sell climax. I think that's okay, but I'm not positive that it's okay. But I think it's okay. 35, more bad follow through for the bulls. These bars all have tails on them, so it could be some sort of wedge pullback on a smaller time frame. But disappointing follow through for the bears on 36 and buyers below on 37. If you sold the close of 32, you're disappointed, obviously, at 33, 34, 35. And some of those traders might sell more below the next bar, trade below another bar on 36, and they're able to get out of break even. But this is still a lot of trapped sell the close bears on 32. And then you get a big bull surprise on 38. It could be 2 legs up, a second leg trap on 38. And especially when you get disappointing follow through on 39. This 38 was never able to trigger because bears were selling the close of it, hoping that it wasn't going to be able to trigger. Additionally, you have bears who sold above 37, thinking this was good enough for another leg down. And that, if we might go up to the moving average, but we're probably not going that far up. And you can see those bears, they were trapped in still on 42. So those bears were never able to get out of break even. But 40 bull bar, but you can see there were probably some orders to buy above 38. It could be a second leg trap, and it's the top of the bull channel. But those bulls who were willing to buy, a lot of them were disappointed that we got 39, which shows a lack of interest in buying in general for the bulls. And so they're no longer willing to buy above 38, which means there might be more sellers than buyers there. And that's causing 40. 41 was a low 2 attempt, but not very good. I'd rather wait for a deeper correction, maybe towards the top of the sell climax before selling. 42, it's a potential midday reversal. A lot of bulls looking for a measured move up, which they obviously ended up getting. But if you buy above 42, you're looking for a breakout of the low 2. And like I mentioned earlier, eventually we do get essentially a wedge and a breakout up of the wedge, and that's where the high of the day was. So bears who, if you sold above 37 and you're still holding, you're disappointed, and then you get 42, a lot of those traders are going to exit, and that's causing 43. It's basically bears giving up on their premise, and that's heading towards the top of the sell climax. Some traders might argue, since 30 was when the market became always in short, that 30 was the top of the sell climax. I think it's probably okay to use either, but it does make sense that 30 is the top of the sell climax when that's when the market clearly becomes always in short. And so you can see we raced up to that magnet on 43 and 44, and bulls who were long sold out of their longs. I'm just curious. I haven't checked this, but yeah, you get 2 to 1 of your true risk. I assume you get pretty much 2 to 1 of your initial risk too. That's interesting. So if you bought, exactly 2 to 1 of the size of bar 42 is where the high of bar 44 is, which is also where the top of the sell climax is. So not a coincidence. And that's what's caused, that's why you get a lot of selling here on 45. Some follow through for the bears on 46, but you're now at the bottom of a bull channel. And then you get a big outside up bar on 47. You have bears who sold below this that are trapped and bears who sold below this that are trapped. And you're at the bottom in general of a bull channel line. So I think okay to buy a 47. Some follow through on 48, but you can see bulls who bought the close of 44 disappointed, obviously in 45 and 46. So a lot of them are exiting their longs, and you're getting this tail on 48, big tail on 49 and 50. So this breakout, while it did break out, it's not really as strong as bulls want it to be, which is a good reminder that you're probably in an overall trading range and not a bull trend. And so you need to be pretty quick to get out. 50, so we have tails on 48, 49, 50, potentially some sort of wedge on a lower time frame, and then an inside bar on 51, which serves as some sort of final flag, and then an outside bar on 52, and then an inside bar. So it's an IOI potential final flag for the bulls. And when you get a breakout of a final flag, usually you're going to test. It's a scalp, and then you test back to the bottom of the flag, which is essentially the middle of a tight trading range, which is what we ended up testing to on 66, the middle of this tight trading range. I had one more. Yeah, this is also a tight trading range, and we ended up testing back into the middle of that tight trading range. So a lot of times with tight trading ranges, you end up just testing the midpoints of them. Even up here, this is really extended, but this is a tight trading range. We got to the middle of the tight trading range. More magnets up here for that to test. So I think I was here. Yep. And we got a big bull surprise on 55 and 56, but big tail on 55. So it could be 1, pullback 2 to 56. This was, bulls are looking at this as a 2-legged correction. Bears are looking at it as a final flag. Yeah. 57, a bear bar closing near its low. Bulls know that most always in bulls are probably going to get out below 57. A lot of them have a decent open profit, and it just makes sense to get out. And they buy the close of the bar, trying not to let it trigger. And they do a good job, but they just end up getting it to test back to the close of bar 56. So that's where they find a lot of sellers, because bulls buy the close 56, disappointed 57 are getting out during 58. 59, bulls try to get follow through, but a big tail. 60, again, tried to get follow through, but just ends up being a doji. We're basically trying to get a strong breakout above this high, but we've kind of failed a couple times at this price, and that's why you get a big disappointment bar on 61. If you're technically trading always in, your stop, we traded up here, but we never quite traded and got to close above the new breakout point. So we got to close above this breakout point. So your stop can be here. So your stop was technically never run. Sorry. Your stop was technically never run on 60, on 61. And you get a bull bar on 62. It's a high 2, but you're buying at the top of a tight trading range. So it doesn't make a lot of sense. Bad follow through 63, test the close of 61. Any bears who sold the close of 61, hoping bulls were going to quickly exit, get disappointed in 62. They're buying back their shorts on 63. 64 could be, if you look at what it's actually doing, it goes down and then up and then down. So you're kind of selling the bottom of a trading range if you're selling below 64. But it is an inside bar, and it's a smaller bar. So it's maybe an okay swing trade. It's just, I don't think always in bulls. They probably have to exit below there, but some would definitely stay long and rely on their stop below 54. And traders who do sell below 64 want fast follow through. And so that when they get disappointment on 65, a lot of them are going to look to scalp instead of swing. And so that's why when 66 starts to trade down, those traders start to scalp out around the bottom of what's probably a trading range as we're testing back into the middle of this final flag, and the bottom of this, what this bull leg. Usually when you get 3 legs, the third leg gets tested. That's really the only good example I have of this right now. But you can see we had, 1, there's a lot of it's fuzzy, but it's like one pullback, two pullback, three or four or one, two, three. So there's a lot of different ways to look at it, but we're testing with 66. The bottom of a bull leg is what's important. The bull inside bar on 67. This is pullback started here, so you could argue it's one, pullback two, pullback three, and a wedge bottom with 67, an okay swing buy. Any bulls who exit below here are looking to buy again above a bull bar, and they'll buy again above 67. Disappointing follow through on 68, but I think if you're a bull, your premise is still relatively valid. Bears are hoping it's a low one in their bear trend and their tight bear channel, but probably not going to work, as low ones usually don't. You can see traders who sold it got trapped. And then you get another bull bar closing near tie on 69. Probably an okay swing buy above 69. But you again get disappointing follow through on 70 and 71 and 72. And then you get a big bear bar 73. And so I think a lot of bulls, they got disappointed with these tails and they're exiting, and that's causing 73. And it's also kind of the top of this trading range. And so those bulls exit. And other bulls would be, looking to exit below 73, but it never triggers. And any bulls who exit there, some bulls will exit as it's coming up, and they'll exit around the close of 72. They're all surprised that we get a really strong close on 74. So a lot of those traders buy back their longs above 74, hoping we're going to race up quickly into this, that magnetic area that I was talking about. And that's exactly what happens. And then they start selling out of the longs, and that causes the end of the day. For always in, I thought it was potentially always in short below 7, but kind of difficult. It might have been, but it's just really hard to stay short. I don't advocate for buying above 15 or buying above 21 or 27, but I think you need to get out of longs in those areas for sure. But a lot of bulls would probably be waiting for better follow through. And then you get a breakout to the downside. Clearly, always in short on 30. Bears probably exit above 34. Bulls can maybe buy above 38. It wasn't all that clear, and I think it's clearly always in long above 47. I thought that was a good trade. And it probably stays always in long technically for the rest of the day. Maybe they exit below 64, but they have to buy again above 67 or 69. And I wanted to start talking a little bit more about limit order traders at the end of these videos. I thought that there was probably buyers below 1 when we went below 1. And there were probably buyers below bars like 8, 15, 21, 27. Probably buyers, a couple points maybe below 35. Probably, like I mentioned earlier in the day, probably sellers above the 2 high and the breakout. On the daily chart, we're in a channel, so it's spike, and now we're in the bull channel phase. And how does the market cycle go? Spike, channel, trading range. So spike, channel, trading range, very high probability that we're going to get a trading range pretty soon. And this is probably the top of it. I don't know how far back the pullback's going to go. I assume we're going to end up getting a couple legs sideways down to at least the moving average. But I would, in general, be looking for a pullback, maybe a 50% correction of the spike, and then some attempt at a reversal up. I've been mentioning, I think the bulls who buy above this bar are going to be somewhat disappointed, and I still think that's true. On the weekly chart, I do think we're going to have to test this 1023 high at some point. I don't think we're going to rally straight up, but something that you do see sometimes is you get a big bull spike like this, disappointing follow through. Traders sell out of their longs and wait to get back to this high because they know bears are sitting there waiting to buy back shorts. So once we pull back to this high, bears buy back shorts, and we get another reversal up. Yeah.